another legislative date. Please, I beg you in the name of God, this matter is very, very important to not only us, but Nigerians that we represent. And we swear by Bible and Holy Quran that will represent the interests of the people. These people partially have spoken. The governors, the National Economic Council, and that
you have made your point. Can I respond to you?
You can rule me out of order.
Let me respond. Let me respond to you. Now, please, we are not here for rhetorics. We are acting on fact. Excuse me. Order, please. Order, please. Order, please. Order, please. Order. Please.
You, because you are sitting there saying saying it's written.
Okay, yeah. So welcome back, everyone. So today, what I want to do is to unpack the Nigeria's 2024 tax reforms bill that was introduced by the president in October 2024. And this is a kind of set of 4 bills that represent like the most ambitious overhauling of the Nigeria tax systems. That has not happened in 2-3 decades. So we can understand why there is a lot of controversy around it. And, from the video, we can see it's passed the second reading from the Senate, but it didn't come with ease, right? You can see a lot of heated debate. It's been stalled for a long time, but at least we can see that it's making progress. But what I want to do in today's video is to really simplify what is all of this conversation about. And probably you make up your mind whether it's a good or bad, bills. I'm going to give my opinion about some of the changes, which I think is not very radical enough. But overall, this video is going to simplify all that you need to know about the whole bill, such that if you are not interested in the news, this video would have at least explained the very important things about this bill. So, but then if you're interested in the full details, you can go to this website, fiscalreforms.ng, to get hang of the whole bill. But if you're not interested in reading all of that, you can just watch this video to the end, and I would give you the key changes that happen in that bill. So the first thing you need to know is that we have 4 bills actually, that's been introduced. And, that's why most time when they talk about it, they say the tax reforms bills, because there are about 4 of them. But the one that is very important to majority of the people, and which is the most detailed part of the bill, is what is called the Nigeria Tax Bill 2024. And this is the major one causing a lot of problems in terms of the personal income tax, the VAT, that is very controversial, the company income tax, the development levy that was introduced. So all the, tax rates, the number of taxes, compliance issues, it's all encompassed in the Nigeria Tax Bill 2024. And that's the major, part of the bill. And that's the major one that I'm going to focus on in this video. The second one, which is probably of interest, which I'm not going to explain, it's also very not big deal. Nobody is really debating it really, is the one that's called the Nigeria Tax Administration Bill. Is just about efficiency in the tax collection. So they're just trying to digitize the tax platform, trying to make sure that it's linked to individuals, TIN number, BVN number, just to make sure that nobody could, evade taxes. That's what that is about. So it's not a big deal. The third one, which is the Nigeria Revenue Service Bill. So what it's trying to do is just trying to replace FIRS, and trying to make it more efficient and autonomous. So that one's the Nigeria Revenue Service. So they want to use the Nigeria Revenue Service to replace the FIRS as we know it today. So again, that is not very important. It's just one of the components of the reforms bill. And the fourth one is the joint revenue board establishment bill. And what does that try to do? So it aims to create centralized board to oversee tax collection, ensuring better coordination. Anyway, so all of these three, the last three, they are not really important. So I want to take us to the most important part of the reforms, which is like the Nigeria Tax Bill 2024, is the one that talk about the rates, the number of taxes, simplifying compliance and all of that. So that's what is going to take our attention, in this video. If you see this one, this is like the first changes, one of the changes that was proposed in that reforms bill. And this is personal income tax. So who are the people that pay personal income tax? They are the workers, the employees. So when you earn salary or you are self-employed, these personal income tax is what you pay to the government. And sometimes you probably would have heard payee, which is like pay as you earn. So most people that work, for other people, the employer will charge the payee, from your salary and pay to the government and give you like the net pay. So let us see like what is currently happening right now and what is being proposed. So from the screen, you probably will see that based on the current PIT regime, if you look at the tax bands, and this is very archaic, and it happened when people used to when the value of the salary that people earn is like a lot. So I would think, in my opinion, that this is very important change. I mean, because most people now earn like more than this. So if you look at the current regime that we have, if you earn like say 1 million naira per annum, which is also, not a lot. So let's assume that you earn 1.2 million per annum, meaning that you collect 100,000 naira every month. Based on these tax bands, what they do is that they first, take the first 300,000 of your yearly, salary. They tax it by 7%. The next 300, they tax it by 11%. They move to the next 500, they tax it by 15%. Till they get to 3.2 million, and that's when they tax it by 24%. But what the proposed PIT regime is actually saying now is that if you earn 800,000 per annum, which is like minimum wage technically, you are going to pay 0% tax. I mean, in my opinion, this looks good, but then if you go up in the band and you start earning next 2.2 million per annum, that's also not a lot. They charge you 15%, still makes sense because now you're paying, less taxes than the people earning like 25 million. But where I start having problem with this, particular rate is that even when you're earning above 50 million naira per annum, which is a lot of money, right, for people to earn, you are still being charged 25%, which in my opinion is not big enough to really, tax the rich people in the society. But that is not my law. This is what is being proposed. They are saying that if you earn above 25%, really the maximum tax you can pay is 25%. I would say that the major thing I would see in terms of value for these changes to personal income tax is to favor the people earning extremely low, meaning people earning like minimum wage, which in my opinion, there are not a lot of them really. But if you're earning minimum wage of 800K, in fact, if you're even paying rent of 200,000, they add that to that, which technically, if you're earning 1 million naira per annum, you are likely to pay 0% tax. So really, people earning minimum wage or just slightly above that, they may be happy because they are paying no, tax at all. That is like the major, changes to personal income tax from the proposed bill. The other one, which are like very intrinsic, is the fact that, it now makes, filing very easy. Right now, about 2% of Nigerians file their taxes, which is different from what you see in other parts of the world where almost everybody files their taxes by themselves. So again, this bill is trying to make sure that there's no a lot of complication in tax, filing all of these, allowances, reliefs, consolidated. There are a lot of technical things that is currently in our taxes that makes it very hard for people that did not go to school, like, people that are not even accountants or tax experts to file their taxes. So that's one of the things another thing that they're trying to propose in this tax reforms bill. Again, all of these are just intrinsic things that the tax reforms bill is trying to do, making sure that even if you are an entrepreneur and you are just doing your own business, like the private SME business, you do not pay the taxes paid by companies. And that is also very important, because most times when you just mistakenly register your company and you move it from enterprises to, company, or you just change the registration process, you suddenly find yourself paying taxes that big companies are paying. So this personal income tax changes is also making sure that if you're an entrepreneur doing your one-man business, not making a lot of money, is helping you, is trying to put you in the same tax band, like you're working for other people. So technically, this is a good proposition in my opinion. And that is so if you don't know anything about, this bill, from this slide, just know that the biggest thing that they are trying to propose is to say that if you're earning minimum wage, you are not paying any taxes, 0% taxes. But then my view is that if you're also earning above 50 million naira per annum, which is a lot of salary, you are still not paying a lot of taxes, because that is just 25% tax rate. So in my opinion, it's not punishing now. It's not collecting a lot of, money from the rich enough, in my opinion. So if we move away from the changes to personal income taxes and we go to company income taxes, if you don't know anything about this bill, just know that this slide kind of summarizes all that you need to know about the company income tax, changes. So company income tax is the taxes paid by companies after they have, accounted for revenue, they have accounted for costs, and they have profits. So that profit is called profit before taxes. But, the tax rate that is put on that profit before they get taxes they pay to the government is charged currently at 30%, technically flat rate. But what they are trying to say now is that they're going to reduce that taxes from 30% to 25% over the next 2 years. In fact, from next year, which is 2025, they are going to charge companies 27.5% on their profits. And, in 2026, they are going to change it to 25%. And that's what is going to happen going forward. So again, this is a very good news for companies, because in the next 2 years, companies will now see that they are paying 25% tax rate instead of 30%. And why do they, propose this? They say that they want to encourage investment and business growth, because when companies make profits, that is what they retain in the business, either to pay, shareholders dividend, or they use it to reinvest in the business and to expand. So good stuff for companies. Another thing you need to know about this company income tax, again, one of the propositions again is that right now they classify small companies as companies that are making 25 million naira in revenue annually, right? But we also know that the value of 25 million has reduced. So again, you need to appreciate the fact that this reform is trying to, bring us to the reality that 25 million is no longer a lot. So small businesses will now be categorized as small business if they earn below 50 million. And this used to be the medium or large scale businesses before, but now they are trying to put small businesses as companies or businesses earning less than 50 million. And meaning that if you're earning less than 50 million, you are going to be exempted from company income tax. In my opinion, good stuff, because we know that the value of the currency has reduced. Another thing that you need to be aware of, which is the last one, summarize it, is that when companies don't even make profit at all, there is something they call minimum tax And that is like a big stress on companies. So even if you make profit, even if you make loss, you are supposed to like be pitied, right? Because you have made loss as a business, but then there's still this law that say they will charge you like minimum tax of about 0.5% of your revenue. But the new tax is saying that when companies make no profits, make losses, there is nothing like minimum tax. So it eliminates minimum. That is like the second changes that you need to be aware of in this particular reform. So that is like the changes to company income tax. I move away from this and I move to the third changes that is a big problematic. In fact, this is like the biggest problem. This is the biggest one that has caused a lot of controversy, which is the VAT. So it's called like VAT redistribution and changes. I'm going to tell you what it's about. There's a lot of things going on here, but I'm probably going to break it down. Let me slow down a bit so that it's not rushed. So what we call VAT today is called the value added tax. It's a consumption tax or sales tax, as the case may be. So generally, if you buy anything, the vendor will charge you 7.5% VAT. So if you buy something of 1 million, for instance, you're going to pay 75,000 as VAT, and that VAT is, paid to the federal government, right? And the federal government will pull that in a pool, and they will share it among the states in a percentage, in a formula, right? So that's VAT. But what they are saying is that they are going to increase that VAT because if you think about it, Nigeria is one of those countries of the world that pay like the lowest VAT. Some other countries pay higher than 7.5, 8.5, 8.7, 15. So the changes being proposed again is saying that in 2025, VAT is going to increase to 10% from the current 7.5% that it is. By 2026, it's going to increase again to 12.5%. And 2027, 2028, 2029, it's going to be 12.5%. And by the time we get to 2030, VAT is going to be 30%, meaning that in 2030, people are going to be paying a lot of taxes on sales or consumption. So anyway, that is still very far, but that is one of the changes being proposed in these reforms. So let me go deeper into this VAT conversion because it's a big deal, right? So as we know it today, the VAT that is being charged, by companies or individuals, people that sell stuff to you, 82% of all of that consumption, they attract VAT. And one thing that is very good about the proposal, this reforms bill, is that right now they are going to charge 0% VAT on all food items, on housing, on education, on healthcare, on transport, and other essentials that are currently about 82% of all the consumption tax in Nigeria. That is something very good. And I really don't think anybody should have a problem with that. So if you don't buy things that are not essential, you shouldn't worry too much about VAT as it is today, because if they exclude food, housing, education, healthcare, transport, and other essential things from VAT, and that's about 82%, what they are really saying technically is that they are charging consumption tax on things that is only rich people or people that can afford it are really buying. So the second thing you need to know is that right now, many small businesses, they are required to charge VAT on their sales. But what the proposal is saying is that, most of the businesses in the country, they are, SMEs, small and medium scale enterprises. And the proposed bill is saying that they are all going to be exempted from VAT on their sales. In my opinion, that is also something very good, right? So if you are a small business and people don't patronize you because they don't want to pay VAT, the proposed bill is saying that you shouldn't worry because the law is going to exclude you from charging your customers VAT. In my opinion, that is something good. Okay, the most controversial one is the sharing formula. So right now, the sharing formula of VAT is based on 20% derivation, 50% equality, and 30% population. And you probably know why some of the northern, leaders are saying we don't like this. It's because if you generate VAT, it goes to a pool, and the people, the state that generate that VAT, they only get 20% of that VAT, and the VAT that they generate is shared equally. 50% of that is shared equally among all the states, and 30% is shared based on population. So technically, the state that have like a lot of population, they get a higher share of the VAT that other people that are probably less populated, but they generate a lot of VAT, they share. I think, in my opinion, that is not fair. But that is what is currently happening in the current VAT regime. So what is the proposal that is generating controversy? The proposal is that now the state that generates, that VAT is going to take 60% of that VAT. Fair, in my opinion. While the 20% of that VAT is going to be shared equally among all the states, and the 20% is going to be shared based on population. So what it's just trying to say now is that if you are a state and you are generating a lot of VAT, you are going to take a bigger chunk of, bigger share of that VAT that you are generating as a state. So in my opinion, what that should really tell the state is that, hey, if you really want to share more in this VAT thing, why can't you create a lot of activity that will make people consume in your state? But then that's still like subject to debate. But that is what the bill is proposing. Other things that probably should be of interest is what they call the export or intellectual property VAT. Right now, if you are probably exporting your intelligence or IP or whatever, you're going to pay VAT. But now they are saying that they want to stimulate export, and so all the export of services or intellectual properties should not have VAT. And this is big because sometimes, especially when you are offering services to foreigners, most of them, they force you to bear the VAT because they don't care about the VAT. So most of the companies or businesses doing export services, they tend to get kind of discount, imaginary discount, just because their customers don't want to pay for VAT and they have to remit VAT to the government. So the proposed bill is going to eliminate that as well. Big deal. I like that. What about VAT refunds? VAT refunds is very, very tough right now, and I have like first-hand experience dealing with that. If you want to get VAT refunds from the government, and what does VAT refunds really say? VAT refunds is just saying that as a business, when you buy things from other people, you pay VAT. When you sell goods or services to other people, you collect VAT. At the end of the day, VAT you collect and the VAT you pay, you net it off, you pay the balance to the government. So if what you have paid to the government or what you have paid, for services is more than what you have collected, that means the government owe you some VAT. To get that money back is always very, very hard because they have to audit you, and some of the tax audit, they can last forever, very stressful. Now they're saying that you do not need to be audited before you get a refund of VAT. In my opinion, that's good news, because if you also look at countries that are very, smaller to us, like Rwanda, in Rwanda, you get your VAT back in 3 days, refund without audits. They credit you. In some other, country like South Africa, then you get it back in like 10 days. So we need to also make businesses have confidence in the fact that they can get their refund as fast as possible without all of this audit happening. So what if you don't understand all this jargon, which is I know stressful, just know that if you need to get your money back from government, they don't need to look at your books, audit you, and start asking for other irrelevant documents before they give you back your refund. So that's a good deal, in my opinion. So VAT is a big deal, is a cross of the matter. But there's an analysis, which I'm going to show you here, that kind of give context to why VAT is not a big deal, right? Because if you look at it, and I want to show you what is going on here. So what happened is that based on the current regime, right, which is like, they call it the remittance model, where you send all the money you generate to the federal and they share it and all of that, versus the consumption model, which is the one that they are proposing. If you look at it, and if you look at Lagos, for instance, Lagos currently, if it generates like 120, $120 million or $1 billion in billion naira in VAT, you can see how much eventually get to Lagos, about 44 billion, But what we are saying right now is that based on the consumption model, if you change it to derivation 60%, equality 20%, population 20%, versus the current model, which is like 20% derivation, 50% equality, 30% population, you will see that really Lagos is still not getting a lot. Because, that's like what is causing controversy. And the data is actually saying the opposite. Meaning that even as Lagos is generating a lot of VAT, with the proposed formula, Lagos is getting lesser, amount of, that VAT, technically. So if Lagos is the reason why they feel like this VAT, redistribution changes is a problem, the current data says that the tax redistribution model is still not going to favor Lagos. In fact, it starts favoring the other states of the federation that are being apprehensive. Imagine Kano is not even getting more based on the current model. Just, and this is the real data, right? And this was also part of the explanation from the reforms team, trying to like give real data of, let's assume that this is VAT by MTN, for instance, and this is how much is generated by Lagos. But anyway, that is the data. But, what this proposal is really saying, and if you go back to it, is to say that this is MTN because, everybody uses MTN. But then by the time we go back to, consumption tax like alcohol, where some of the states in the north, they don't, VAT it, or they don't allow a lot of sales of it, it may be not beneficial to them because derivation is not going to be favoring Lagos State. So that is why they are really concerned about, the redistribution model. Okay, so if we move away from VAT anyway, my opinion is that VAT, based on this MTN thing, it looks like it's not favoring Lagos. By the time we go to other consumption or other products that is exclusively being sold in Lagos, like a lot of alcohol or a lot of hotel sales, we'll now see that Lagos probably will get any more of that. But the real thing is that if your state wants to get VAT, you need to generate activities in your state. That is like the strategy, the idea behind it, so that you only share a lot of things that you generate. Okay, that's about it. So fourth one, which is like the last one, is the development levy. And this is also very low stake, right? In terms of, so right now there is a lot of taxes, apart from the company income taxes that companies pay. They call one, tertiary education tax, information tax. Last ending. So there is all of these taxes that all the pieces, they are very confusing. Some people don't even know they exist. So they confuse a lot of CFOs or a lot of businesses. So what this bill is saying, again, is that there is something now called development levy fee. All these other special taxes, it replaces them. It's going to be 4% next year, 2025. And it's going to gradually reduce to 2030 by the time development is happening in the country. So they are just saying that forget about all these special taxes that people don't even understand what is going on there. Let us call all of these special taxes development levy, and let us tax it 4% of profit of companies. And over time, we are going to reduce it to 2%. And that will be about the tax we have. So, in summary, what is this proposal about? Yes, I've said a lot. So, and I mean, if you can spend time to look at this video, what I have, proposed in this video is all of the changes you need to understand about this tax reforms bill being proposed. And again, what is the goal? Again, the goal of this reforms bill is to simplify compliance, is to protect low income earners, and also to incentivize businesses to grow. Because if they are reducing company income taxes, that means companies have more money to grow. If they are reducing personal income taxes for low income earners, it means that the money they earn, they should get everything, 0% tax. And some of the exports, taxes that they're trying to remove as well is going to make exports activities to increase. But then there is this almighty VAT, redistribution problem that is trying to force states to be more responsible, to be more creative, because if you are going to be getting 60% of the VAT you generate in your state, then what that means is that, why can you not be generating VAT in your state instead of relying on VAT generated by other states? So that is all about the Nigeria's tax reforms bill, 4 of them, but the major one that we discussed is the Nigerian tax law bills, which is just trying to restructure taxes and reduce the number of taxes that we have that's very archaic, and make sure that the rates they are charging is reduced. So that is what I want to discuss in this video. If you find it helpful, share, comment, let me know what you think about it. Again, the tax bills have passed the second reading in the Senate, so it's likely that it's going to be approved. My opinion is good. When you put in net, I think it's good. The states that are complaining about it, majorly the northern states, they have very good reasons to complain because, again, to their argument, they feel like if more of the activities are generated from this region and the consumption is happening in another region, why do you want to punish them because they are not consuming? But again, as we know, consumption taxes everywhere is based on how much is consumed in that destination. So I just feel like it makes sense on a net basis. So that's about it for this video. I'll see you again in my next video. Take care. Bye.